Hey there, this is Joe Dobert. I am the founder of Dayton's Bluff Financial up here in St. Paul, Minnesota. And I want to talk to you today about children's life insurance. We don't think about kids often when we think about life insurance. And I think that's because we've gotten ourselves in this mindset of thinking about life insurance in terms of a death benefit and what it can do for us when we die. And of course, a new parent isn't thinking about their child dying, right? The thing though is you got to start thinking about life insurance as part of your financial portfolio, a way that you can accumulate and protect wealth. And I think that children's life insurance is one of the most important tools that new parents have to secure the financial futures for their kids. Now, there are two good ways to insure your kids. The first one is simple, and I like this for a lot of my clients. I like this for me. I like simplicity. I like something that's going to be really easy to maintain over the years, and I like the low price of this. And that's children's whole life insurance. I know you've seen the commercials on TV for the companies that do children's whole life insurance for $1 a day, less than $1 a day, something like that. Similar to that, I use reputable companies. We use some pretty solid companies because I guess I can't really talk about specific products in here without getting the carrier's approval. So I'm not going to go into that on video, but I'll show you the carriers that I use for that when we sit down and talk about this individually. What I like about children's whole life insurance is, like any whole life or permanent policy, it accumulates a cash value, which means that at some point, if your child needed to 30, 40, 50 years down the road, they could borrow against that cash value. I also like that it's permanent coverage. It's going to go to age 100-ish, depending on the state. Each state handles that differently, but it's until maturity, and when it matures, it cashes out at the face value, so you don't lose the money that you put into a whole life policy. I also like that it's a level premium. Now, remember that your premium is based on the age at which you buy the policy, or you purchase that unit of insurance. So if you are buying insurance for a 14-day-old, you're talking pennies a day. It's dirt cheap to buy insurance for a child. That pennies a day is locked in all the way to maturity date. The other thing I like is that the face value doesn't decrease. So if you buy a $50,000 policy, that policy is good for $50,000 for the life of the policy as long as the premiums are made, those pennies a day premiums, regardless of whether or not your child gets sick or starts engaging in some behavior that's going to make them less desirable to insurance company, make it hard to get insurance. Another good thing about it is that it's issued on a simplified issue basis typically, a couple medical questions, a lot less medical questions than an adult would answer, and coverage can happen very quickly. Now, I alluded to the risky behaviors that kids can engage in as they get older. Of course, we think our kids are going to last forever. I wouldn't want to imagine a child passing early, but cancer happens. I've had some good friends who've gotten cancer over the years. And kids get reckless. They do things that you wouldn't automatically think of as being a red flag for an insurance company, but scuba diving, hang gliding, mountain climbing, spelunking. I mean, all this stuff really makes an underwriter in an insurance carrier's office pull a little bit of their hair out. These things can make it very difficult or impossible for them to get insurance. Now, with a children's policy, a children's whole life policy, there is a guaranteed insurability feature, which means that they can get future coverage at certain points, even if they're engaging in these activities, even if they've been sick, if they would otherwise not qualify for this type of policy, they can keep insuring it. Now, I want to use an example here. I want you to imagine that your child is he's a 40-year-old scuba diver who's having kids. Suddenly, they can't get a permanent policy. Now, if mom or dad or grandma and grandpa, or dad and grandma and grandma, whatever the family situation is, if those people who could buy them a policy when they were a kid for a few pennies a day had bought them a $50,000 policy as a child, no matter where they are in life, they would be able to get future insurance. Now, the companies vary on where and when they will let you do this. Some automatically double at 18, some have extra periods in which you can buy it. But I pulled one of my favorite carriers, and I will show you where they let you insure this and tell you what we could have done. So if we bought little Bobby Baby a policy at age 14 days, so right after they're born, for $50,000. Bobby could get another $50,000 of coverage at age 25 for $100,000, age 30 for $150,000, Age 35, another 50 for 200,000. Age 40, another 50 for 250,000. If little baby Bobby buys a house, he would have the opportunity to purchase another $50,000 in coverage without medical exam, without health questions. Doesn't matter. Cancer, heart attack, stroke, rock climber, mountain climber, skydiver, doesn't matter. Another $50,000 for $300,000 in coverage. And at the birth of a child, another $50,000 for a total of $350,000 in coverage. That's a heck of a lot more insurance than no insurance that this child would be able to get at 25, 30, 35, 40, at any point in there where they should be thinking about insurance. You would have done them a huge favor in addition to providing them coverage young. So I want you to think about this not so much as my kid's not going to die, because that's definitely what we're hoping. I want you to think about this as, this is how I can lock coverage in for my child, no matter how silly and reckless and invincible they think they are later on in life, so that they're protected, so that their family is protected. So you're thinking about your grandchildren, or if grandma and grandpa are buying this, your great-grandchildren. Now, another good way to cover children is with an indexed universal life policy, which can typically be bought on a simplified issue basis. It's going to accumulate cash. It's going to have a level premium. I guess I hesitate because you're going to have a minimum premium that you need to make that doesn't go up. With an IUL, you can increase it. You can sometimes decrease it if you need to. You've got a lot more flexibility in that, and I guess we'll do another post on that. But think about level premium for this sake. It's got a lot of the same benefits that a whole life does. You will not necessarily get the guaranteed insurability automatically like you would with the children's whole life, but what you're trading for that is that an IUL accumulates cash potentially at a much higher rate than a whole life policy does. We always think of an IUL as it's a little riskier because you can earn zero. You can't lose money, but you can earn zero, or you can earn a ton more depending on how the market is performing. We'll talk more about IULs in another one, so make sure you subscribe for updates on our Learning Center, or keep checking our Facebook page for these videos. At any rate, you can accumulate a lot more cash. So what an IUL is good for is to set your child up so that at age 21, when they finish college, they can take loans against their policy to pay their tuition, or at age 70 or 65 or whatever point they retire, they can start taking loans to help supplement their retirement. So with an IUL, instead of necessarily building in that guaranteed insurability, you're setting them up with access to cash value of their life insurance policy at a young age when the cost of insurance is almost nothing, and you're also able to set them up with a much bigger death benefit. Now, again, it's not so much that your child is going to die. We don't want to think about that. And my hope is always that all of my clients live forever. I love all of my clients. I love my family. I love my family and my friends. But we need to think about insurance not just as a death benefit. We need to think about it as a way to secure our future financially. It's the foundation of your financial portfolio. This is how you save money, protect your wealth. So that's what I got for you today. Children's whole life. It's not about the death benefit. It's about building a future for your children or your grandchildren. Moms and dads and grandmas and grandpas can all buy insurance for their children or grandchildren. So give us a call, send an email, let us look at some illustrations for you. We'll show you what a whole life can do for your children or grandchildren. We'll show you what an IUL can do for your children or your grandchildren. I promise you, though, there are ways to do this for so little money that you would never even miss it coming out. And as someone who is a little bit more, I'm older, I'm harder to insure, my insurance is expensive. I wish that someone had told my parents about this 40 some years ago, because it would have really changed my life right now. So contact us and let us show you what we can do for your kids and your grandkids. Love to help protect them too, because that's what this is about. It's about protecting your family. It's about, loving you like we love our family and helping you love and take care of your family as well as you should be. Thanks.